Hello everyone, welcome to today's presentation. You're tuned in to Pro Traders Academy. You are on to the foundation series, the Forex Foundation series of the Pro Traders Academy. My name is Uncle Clint and I'm here to take you on this section and teach you some of the basics and the foundation of the Forex trading industry. Alright, so this topic today is talking about when do I trade Forex? A lot of times people be asking when is the best time to trade Forex? After this video, you'll be able to answer that question. When do you trade Forex? Or when is the best time to trade Forex? Alright, so let's get on. I would want you to pay very close attention, get your notes and your bios so that you write down the key points and everything we're going to be discussing here because this is school for you guys. This is school. Pro Traders Academy gives you the best Forex education and trading education that will help you become a successful trader. So please take it very seriously and make sure you write down everything we are discussing right here. So let's go, guys. Upon finishing this video, you will be able to answer these following questions. What are the 4 trading sections? It means that we have 4 trading sections, so you're going to be able to tell me or tell anybody you meet the 4 trading sections. All right, what happens during each trading section? When is the best time to trade? You'll be able to answer this question for yourself. When is the worst time to trade? You will also be able to answer this question. What do the words volatility, liquidity, spread, and volume mean in the Forex market? You're going to be able to answer these questions at the end of this presentation. Alright, so let's discuss some of the vocabularies, some of the things you're going to be hearing in the Forex market a lot. Let's talk about them. You have liquidity, you have spread, you have volume, and you have volatility. So let's discuss those things. Alright, spread. You all know that Forex is simply the exchange of one currency for another. For instance, what you have here is the Euro USD, and the Euro USD, there's certain exchange rate that is always quoted. Alright, you should also know that here the Euro stands as what we call the base currency, while the USD stands as what we call the quote currency. Alright, and of course both of them come together like this as a pair, and of course you have this value we call the sell base currency and of course the buy base currency. These values would be also represented as bid and ask. You are always going to see 2 different values when you see a particular currency pair on any trading platform. You're going to see 2 prices. One represents what we call the bid and the other one is the ask. Alright, now when you have a particular figure like 1.08660, that would represent the bid, which is the sell price, and of course the buy, which is 1.08674. You've noticed there's a little difference, there's a slight difference between this base currency and the quote currency, even though we're talking about one currency pair. Now note that the exchange or the difference between these 2 figures stands at what we call spread. And this is one way that the broker make their money, but not the only way. Please note, spread is just one way that the brokers make their money. There's so many other ways brokers make money, but one major thing you'll be hearing in the Forex market is spread. So know that the spread is the difference between the bid and the ask price. The spread is the difference between the buying and the selling of the base currency. The base currency here is euro. It means that 1 euro will sell for $1.08660. And of course, if you're doing the buy, that's the reverse. You're going to be doing 1 euro. You're going to be exchanging a dollar, 1 euro. You're going to get to buy it using $1.08674. That is how the exchangers would be trading this currency. So each time they either sell or buy a particular trade for any trader from all over the world, they're always going to have this spread that they keep to themselves. Alright? So that is what spread is about. Spread is the difference between the bid and the ask price. And of course, this spread does not always stay the same. It changes from time to time. It always switches up and down, depending on how the market is flowing. Okay? Now we have what we call volatility. Now, I need you to understand that volatility is where your money is in the forex market. Volatility is simply the aggressive movement of the market upwards, downwards, upwards, downward. That is what we call high volatility. When you have, look at this blue representation here, it simply shows you high volatility. It moves up and down aggressively. I need you to understand that's where the money is, because it presents high opportunity and of course high risk. Remember, this market is about risk, but of course calculated risk. So when there's no risk, there's no money to be made. The low volatility is when the market is just crawling, you can see the blue line just crawling, no major move up and down. This is not a time to be in the market. You're not going to make money. You're going to stay in there days and days and days and no money. And then note, there are certain currency pairs that have high volatility and some don't have high volatility. These are things you'll be learning in some of our advanced courses. You're going to understand better some of the currency pairs with high volatility, because that's where your money is. It's not in the low volatility times. There are times when there is low volatility. When there are holidays, for instance, there's low volatility. All right? When conditions in the market begin to change rapidly, that's high volatility. These are big moves that take place when major moves are released. It's actually the trader's paradise. That's where the traders make money. And low volatility is when the market is sluggish. No major news releases. It's trader's nightmare. You're just going to be there, no money. You're not making any money. You're just basically waiting on the market to make some moves, and then you hope and hope and hope, and nothing happens. So I hope that clarifies volatility for you guys. All right. So we have what we call liquidity. Liquidity has to do with how much participants are in a particular market. Low liquidity means that there's no major trading going on. Low liquidity means that the money in the market is just too small. Not too many participants in the market. It's the worst time to trade. These are things like holidays, when the major banks are on holidays, during Christmas seasons, during major football leagues, and times when you know that the major economies of the world are on holiday. You have low liquidity because there's not too much transactions going on. This time around, the markets will not be moving up and down. There's not going to be major exchanges going on. This is not the best time to trade. Then you have high liquidity, lots of participants in the market. This is the best time to trade, okay? And of course, that happens at the times when the major economies of the world are actively trading. This is different from volatility. Please note, it's very different from volatility. Now, you're also going to understand certain currency pairs have high volatility and high liquidity, while some have high volatility and low liquidity. You're going to understand better in our advanced classes, all right? All right. Then we have what we call high volume and then low volume. When you talk about high volume, you're talking about market participants doing large number of trade in a certain currency pair. For instance, things like Euro USD, you always have high volumes. High volumes means that people can place millions and billions of trade orders on Euro USD for a buy or for a sell. That is high volume. All right, and low volume is not too many orders are happening. Like in the holidays as well, there's also low volume. The end of London sections, beginning of Sydney sections. These are sections when trade occurs. We're going to discuss that in detail as we progress. All right, so let's move on. There are four main major forex sections. Four main major forex sections. Note that we have the Sydney section, the Tokyo section, the London section, and the New York section. The Sydney section opens the market. Now, note that Forex is traded 24 hours daily for 5 days a week. The 5 days is from Sunday night till Friday night. Sunday night to Friday night. So, and the market usually opens with Sydney section. Sydney section, of course, serve the Australians, the New Zealanders, and all that. But that also serves the entire world. Once they are awake and they are up and they've gone to work, the Sydney section opens up. All right. The Eastern time you have here is for those in America. If you must convert this to your local time, you can check it on Google and find out the Forex local time for your country. What we have here is 5 p.m. Eastern Standard Time. That is for those in America. The Tokyo section opens 7 p.m. Eastern Standard Time. London section opens 3 a.m. Eastern Standard Time. And New York sections open 8 a.m. Eastern Standard Time. And below it is also their closing time. Okay, and I need to understand that some of these countries, when they open for work in the day, the time they are closing, the other country or the other regions of the world might have started work as well. Automatically, you have a certain section overlapping another section. For instance, in the screenshot you're going to see next, you're going to see a screenshot that represents how this overlapping happens. Okay, let's discuss in detail the Sydney section. This is where the trading day officially starts in the forex market. It's the smallest and the calmest of the mega market because why? It's mostly the Australians and the New Zealand dollars that is moved around there because that is the part of the world that's awake at that time of the day. It favors mostly Australian and New Zealand dollars because, of course, the people from that region would like to trade their currencies more often. It doesn't mean that people from other part of the world can't trade it. They can trade as well. But then note that it's the people from that part of the world that trade that section the most. Now that time is 9 p.m. GMT, and of course it closes 6 a.m. GMT. So you can add your own GMT difference, maybe +1, +2, +3 to that time. You know what it is in your own local time. 9 a.m. GMT to 6 a.m. GMT. Sorry, 9 p.m. GMT to 6 a.m. GMT. That's the Sydney section. And then we move on to the Tokyo section. This is second section for the forex market in a day, or in a forex day. And the third largest forex trading center in the world. That's where we have it, in Tokyo. Japanese yen, which is the most traded, the third most traded currency in the forex market, it sees about 6% of forex transactions. Part of the Asian sections would also overlap with the Sydney section. Alright, so that means before the Sydney guys go to bed, the Eastern section would have opened, so there's going to be some overlapping happening. Alright, low liquidity and high volume is also expected. Higher spread is also expected. Now, what's the time? When does it open? This is about 11 p.m. GMT to 8 a.m. GMT. So it opens around 11 p.m. GMT and closes by 8 a.m. GMT. Alright, so we'll move on to the London section. The London section is the third trading section for the day, a forex trading day. And of course, the major currencies that will be moving around at that time is GBP, Great Britain pounds, Euro, and Swiss franc. Historically, London has been the center of trading in the world, the center of commerce in the world from time immemorial. 34% of all forex transactions happen about this time. Is the most active trading section. It has high liquidity, high volume. The spreads are lower at this time. Major news releases come up at this time. And the time when it launches is 8 a.m. GMT and 5 p.m. GMT. So you can add your own GMT difference to know what the time it is at your local region. And then we move on to the New York section. The New York section marks the end of the forex day. 85% trades involve USD. Of course, it's the United States. What do you expect? There are big moves that take place in this market during the early New York sections. Major news releases occur around the start of the New York sections. The USD and the Canadian dollar pairs are the most traded. Volatility dies down after a while. And what time does it open? It opens from 8 a.m. GMT and shuts down 5 p.m. GMT. Alright, so that's that about the sections, guys. So the question now is that what is the best time to trade? Someone's going to ask, when will be the best time to trade? Well, I usually answer by telling you it depends on the style of trading you are doing. Remember, if you haven't been told this before, or you've not watched our video that explained the types of traders that we have. We have those who call the scalpers, we have those who call the intraday traders, we have those who call the swing traders, or have those who call the position traders. Now, for those who bought about what time of the day to trade will be the position. Oh my God, what am I saying? That will be the scalpers and the intraday traders. These guys trade within a day, but every other person can care less about what happens in a day. What do I mean? The swing trader and the position traders, their trades run past 2, 3, 4, 5 days. Some even run to weeks and months. So they may not necessarily pick a particular time of the day that is the best time to trade. No, no, no. They don't do that. Because why? The influence of the day doesn't have much impact on their trade. The guys who bother about what time of the day to trade, what best time to trade, is the scalper and the intraday trader. So let's move on and see what works for them. The best time for those guys will be when there's an overlap. What do we mean by an overlap? When there's a Sydney overlapping Tokyo, or when London is overlapping America, and that's New York. Of course, you have higher participants in that market that time. The market moves a lot around aggressively, so you expect high volatility, and that's where you expect to make money. Two major world markets open at the same time, which equals what? High volatility, high liquidity, and high volume. The London and the New York section, they both overlap at a certain point. London and Tokyo also overlap at a certain point. So I will give you the assignment to go find out more. Don't mind me, I have the information here. Now, this you are looking at is a screenshot that explains how these markets overlap each other. The Sydney section, when it opens, it's overlapped by a Tokyo section. And of course, the London section, which you say one of the most active and most heavily traded sections, the London and the New York section. It opens at 8 a.m. GMT, and of course, it's met by the New York section around 1 p.m. GMT. And that automatically causes an overlap between 1 p.m. to 3 p.m. There's going to be aggressive trading going on. High volatility, high liquidity, and high volume will be traded. So for those doing scalping and intraday trading, they can be in the market at this time because they are obviously going to make money. Of course, lose money if they don't get the analysis right. Cool. So let's move on. When is the worst time to trade? Now, for you to know the worst time to trade, that means you should also know the best time to trade. If you take away the best time to trade, what are you left with? The worst time to trade. That would be during the New York section after 1 p.m. Eastern time, when the overlaps stop. When the overlap stops, of course, there's going to be drop in volume, drop in volatility, and drop in liquidity. And of course, during the start of the Sydney section, we say that is the section with the lowest liquidity, so the lowest volatility. And when there are no overlaps and when there are major holidays, these are times you want to stay away from market. For those doing intraday trading and scalping. Alright, so let's look at this screenshot, guys. Now, you also have these times that would like you to understand and be able to memorize. You have times like trending and consolidation. Trending and consolidation. I will discuss that in detail in our subsequent videos and subsequent trainings. But right now, we just want to show you a screenshot here. This screenshot represents a trade on USD JPY. USD JPY trade is what you're seeing here. And the gray region represents when the market is moving upwards. And you're going to see sometimes when the market is moving sideways, sideways, sideways. Now the gray shaded box, in this gray shaded box, the market is making some major moves in the upside direction. Possibly due to news releases or larger volumes of volatility. Of course, whoever is buying this currency at this point is making money. USD JPY, if you're to buy it from the bottom here and it goes all the way up here, you're going to make money. But after a while, you realize that it drops, and when it drops, it starts making a sideways movement. Now, this is what we call consolidation. A lot of candles will form, but direction is not in neither up neither or downwards, it's just sideways. This is not the time to make money. You're in this market right here, you might not make money because why? The market is just going to be crawling left, right, left, right, left, right, up, down, up, down, up, down. No major move up or major move down. Automatically, you're not making money here. This word of advice is mostly for day traders. If you want to hold your trade for long, like a couple of weeks, no need to close your trades. Now, what do I mean? Remember I said earlier, these guys who bother about what time to trade, what time of day to trade, usually intraday traders, also known as day traders, and of course you have scalpers. These guys are those who are bothered by what happens within the day. For those who trade long term, the analysis would run into 2 days, 3 days, 4 days, sometimes 1 week, 2 weeks. If your analysis is correct over time, the market will correct itself. After doing all this consolidation, it will keep moving the direction it ought to move, either upwards or downwards. So with that being said, I think I was explaining to you what we mean by, trading times and the best times to trade. Now, I need to also do a search for yourself, the trading sections that matches your own local time. If you check that on Google, you'll be able to find that. You're going to see a lot of sites that's going to give you some insight on that, okay? Now we're done with this section, and I hope we'll learn something. So you should be able to tell me or tell anybody what are the 4 trading sections? What happens during each trading section? When is the best time to trade? When is the worst time to trade? What do the words like volatility, liquidity, spread, volume, and volume means in Forex? If you're able to answer these questions, congratulations. You are way, way ahead in your trading career. Thank you for tuning in. My name is Uncle Clint once again. I'm with the Pro Traders Academy. I'm a mentor and a coach, a senior trader with the Pro Traders Academy. I'll be glad to keep teaching you if you will stay tuned with us by going onto our website. If you're not there already, sign up with us and stay in tune with us. Also, like this video, share this video, invite your friends to know what we're doing. Come learn with us. We have physical training locations. You can find them on our website. Thank you and have a wonderful day ahead. Cheers.